Very, very cool. So we'll let everybody into this. So as we get everything settled in, Jim's drinking what are you drinking over there, Jim? Iced tea?
Water.
Water. Good. The same thing. Out of my White Sox cup. So 5 in a row. Beat the best team in the American League twice the last 2 nights. So
you guys are on a roll.
It's a beautiful thing. So I know there's probably some Cub fans out there. It's all good. It's all good. There you go. Jimmy's a Cubs fan. There you go. So they have to, everybody's going to like you more than me. But I'll promote the Sox. They got a chance to go to the playoffs. So
there you
go. Good deal. So as we get the doors open, it's right around 12 o'clock, and we'll give everybody a couple minutes to get in, checked in and all that. And then we'll get introductions around the horn and thank our amazing sponsor. So we'll get to that first. So which is good. So it's right around 12 o'clock. This is good. Those of you who are here might actually have some fun prizes if you stick around. We'll see. So we're going to be looking for some interaction here. So we have prizes for people who have questions and are interacting. So how you guys get those is you jump into the chat box and post your questions. And Tony will put a little note in there just to say, hey, look here in the chat box. But there it is. Perfect. So that's awesome. And we are going to get started as it is officially 12:01. So there you go. We're going to get started with everything. So first and foremost, we have big thanks goes out to Lisa.Cichy with Enact. And Enact is one of our mortgage insurance partners. And I know, we were talking about a mortgage insurance presentation and Lisa's like, oh my gosh, how boring. But let's put it this way. Your buyers do not get to buy with less than 20% down on a conventional loan without Lisa's company. So, and Lisa's company, aside from the fact that she helped pay for our lunches today, and we thank her for that, she also has a really cool little program that if we have a conventional loan and we utilize Enact, she's going to be able to offer some additional little perks to your buyer. So Lisa, I'm going to turn it over to you so you can tell everybody a little bit about Enact and a little bit about this benefit that you give to our buyers.
Oh, great. Thank you, Rich. And thank you again for inviting Enact and myself to participate and support the webinar. So we're very excited about that. I won't take up a lot of time because I know myself included, I'm excited to hear what Jim has to say this afternoon, but I did want everybody on the webinar to know that because they're doing business with Rich and CrossCountry Mortgage and through our partnership together, each homeowner that closes a loan with CrossCountry Mortgage with Enact MI, and like Rich said earlier, we try to keep people in homes, we try to get them in homes and keep them there. Your homeowner will have access to a program called Home Sweet Home. So this program gives your homeowners an opportunity to choose from one of 3 benefits. And after closing within 120 days, they get to pick, excuse me, one of these 3 benefits. So I'm just going to briefly go through each benefit, but if you have any questions, you're more than welcome to reach out to Tony or Rich, and they can get you in touch with me and we can get a response back out to you. But the first one, excuse me, is our most popular one. It's probably the most widely picked out of the 3 choices that the homeowner has. So it's called Homeowners Insurance Deductible, and it reimburses your deductible up to $1,000 for covered losses that exceeds the homeowner's insurance deductible. So this product or this choice is available for 5 years after closing, and it's the most popular because of the savings that it has associated with it. So if you're looking to possibly reduce the cost that homeowner might have to pay for homeowners insurance, or Rich, if you were having maybe an issue with DTI, this is a program that might help because of maybe reducing that homeowner's insurance policy might help with that DTI and help save the borrower some money. So this is usually why it's picked probably as the first choice. So you want to think the lower the deductible, the higher the premium usually. So with this, they can have a higher deductible and have the benefit of that $1,000 coverage. And then the second, sorry, Rich, go ahead.
No, I said that's great stuff. I mean,
Yeah.
that's such a great benefit to our buyers. So we really appreciate that.
Yeah, it is. And then it is at no cost to the homeowners. So this is just, it's a benefit to them just by going through you and having Enact MI. So no cost associated with either one of these options. And then the second is the appliance warranty. So it won't cover the furnace or maybe the hot water heater, but think dishwasher, refrigerator, stove, washer, dryer. It'll cover up to $500 in repairs or replacement. You do have to pay for a $95 service call, and this is provided up to 1 year. So if that homeowner is getting maybe a warranty through the seller or through the builder, they can also defer that year to the second year. So then they really have 2 years of appliance warranty. And then the third option is identity theft reimbursement. So I know most of us hear a lot about data breaches in the news, and I think it tends to come and go and be a highlight, but this option covers up to $1 million in expenses incurred because of theft, a data breach, fraud, and it's up to 5 years. And it also provides restoration assistance. So again, if you think rich, CrossCountry mortgage, you got a loan with MI, you think Enact, the borrowers that you are working with on finding homes and getting them placed will have this benefit at no cost to them.
That's great stuff, Lisa. I appreciate you. We appreciate you a ton and appreciate some of the benefits that brings. Tony, I wanted to just double check with you. We got a note from one of our agents that the chat was disabled. So want to make sure that we're getting that squared away so we can get some interaction.
Working on it right now.
You are? Okay, good. There you go. All right, good. So we'll get the chat up and Tony will let us know when you guys will be able to get back into that. So Lisa, again, thank you. You guys are great partners. So we really, really appreciate the partnership and some of these extra little perks. We talked to our agents about making sure that we're both really sticky with clients because unfortunately, if the client leaves the agent, sometimes they're also going to leave the lender and vice versa. So if we can give them extra added benefits such as, hey, you can have a high insurance deductible and lower insurance costs, that's a really good thing. So we do appreciate that a ton. All right. Without further ado, we've got our featured speaker today, and that is Jim Droske. Very happy to actually call Jim a friend of mine personally, and also let you know that for the last 13 years, we have referred him consistently our clients for credit restoration. And interestingly enough, he's the only guy we refer. We don't get complaints. He's local. And aside from that, he's got a ton of credentials that I'm sure he's thrilled to tell you guys about. So without further ado, before I introduce Jim, our chat is open and is fixed. And don't forget, I got prizes for you guys that are going to be interactive with us. So Mari, thanks. You've already won one because you told us that our chat was disabled. We appreciate that. Without further ado, Jim, I turn everything over to you. And as you guys, one quick thing, as you guys hit the chat box, I will probably find opportune times to interrupt Jim with your questions. But right now, we're going to turn it over to Jim.
Cool. Thanks, Rich. I appreciate it. Hello, everyone. And so I'm here to talk about credit and how things work with credit, but this is going to be a little different than what we've normally done. There's a lot of different avenues that you can go down with credit, talking about how the scores work or what gets reported, what doesn't. There's a lot of different things, but what I'm going to talk to you all about today is probably the most significant thing that I've ever had to cover in the world of credit, because it has to do specifically with the mortgage FICO scores changing. None of this is publicly known yet, but it's really relevant. Even if you're not the one pulling the credit reports, your client's credit scores are obviously affected, and that impacts your industry. So it's really important. I've always said that education is really important. It's good to be able to pass that information on to your clients. And I'm a resource for Rich. I'm a resource for all realtors, all loan officers. I'm here to spread information about credit. We do credit repair. This is not about that right now. We can talk about that another time. So let's start digging into this a little bit. And I'm going to share my screen. As Rich said, I like questions, so throw them out there. The more the merrier. So hang on now. I can't see that. Hang on. I can't see to start the slide. Okay, can you guys see that okay? It's really small. Hold on, sorry about that. I'm trying to get to, I'm trying to see my top part here because I
Jim,
can't.
if you go to slideshow,
Yeah, I
and
can't see that.
click. You should
Yeah,
be able to
I got
click.
the bar of the Zoom across the top, and I'm trying to get that on. Oh, there we go. Here we go. Sorry about that technical error. Okay, ta-da. There we go. Okay.
All right.
All right. Illinois Credit Services. I like to, as Rich kind of said, I'm going to talk a little bit about me. And here's the reason I bring this up is there's a lot of so-called credit experts out there. They're all over Facebook. They're all over the internet. And half the stuff that you're hearing or seeing on Google is just simply not true. And so being endorsed by Rich is great. We worked together for 13 years, like he said, but I like to cover my background a little bit. So I've been in the credit game for 32 years. I started Illinois Credit Services in 2009. I've taught classes on credit and credit scoring at the College of DuPage for I think almost 9 years now. I've done a bunch of stuff with CNBC and radio and things like that. So probably the biggest thing though, I'm an expert witness in court cases. In federal court, they will also, law firms will hire me to testify and explain how credit and credit scoring works to judges and juries when they have a component related to credit scoring. And that's a big deal, obviously, because you don't go into federal court unless they verify you're an expert. So that being said, let's start diving into all this information about these changes that are going to be coming. So why is this not clicking?
Hey, Jim, while you're doing that, I'm going to answer a quick question that's
Yes.
basically directed to me. So that way you're sorting that out. So Ken, you had asked, is it normal for a lender to pull credit multiple times to get financing after a client has been approved? The pulling of credit can happen multiple times. So it is tend to be, I guess it would be considered normal. A lot of it depends on the lender that you're working with and their source where they're going for money. So a mortgage broker, as an example, is going to give that file to their end lender, and their end lender may end up pulling their own credit report. Additionally, as I understand it, MI companies may also want to pull their own credit report through their underwriting and due diligence. So there are other opportunities. And then lastly, you also may end up with a credit report from your lender at the end, or I should say a credit pull at the end, so that they can make sure the client hasn't opened up new debt. Now, CrossCountry does not pull credit at the end. We don't want to do that, but there is a check that we can do, that we're required to do, to make sure that we have a loan that's saleable. And it's just a simple check with the borrower. We're not looking at their scores. We're not looking at their balances. We're simply looking, did they open up any new debt from the last time that I pulled their credit to today? If inquiries come up or the new debt comes up, then we're going to go back to that borrower. That's that nightmare scenario when you say, hey, I lost my deal because the client bought an Escalade a week before they close. That's where that comes from. So that hopefully answered your question on that. Can you? And then, okay, good. Judy asked about a pamphlet. We do have something, Judy. We do have something that Lisa's going to get us that we will actually be able to forward to you guys, sharing the benefits of the home sweet home from Enact. So with that, I'm caught up on questions, and go ahead, Jim.
Okay, so I want to cover really quickly the 33-year span of why we're at where we're at with credit scores right now and why they're changing. So FICO scores, and I'm sure you're all familiar with FICO scores, right? But you also have your clients going to Credit Karma or Credit Sesame or all these different places and thinking their scores are one thing. And then when Rich pulls the credit, the scores are very different. So there's a lot of scoring models out there, but we're talking specifically about mortgage scores right now. So in 1989, prior to 1989, there were no scores on credit reports. They were just reports with information. The three credit bureaus got together and hired a company called Fair Isaac Corporation, which is FICO, to grade a credit report and put scores on there. That started in 1989. Then every few years, they come up with new scoring models. It's kind of like a Windows operating system or a generation of an iPhone. Every few years, they'll come out with Windows Vista, Windows XP, Windows 7, 8, 10, and they develop and they change over time. Well, the models that are still currently used to this day for mortgage use is the models that were developed in 1999. They're 23 years old this year. And there's reasons why they haven't changed that, because by law, they were not allowed to change those. When they created mortgage-backed securities and bundling, they basically had to come up with one uniform way to grade all those mortgages. So they said, here's the scoring model, everybody uses it, and that's it. And by law, lenders wanted to adapt and keep up with the times, and go with an iPhone instead of a flip phone, right? So, but they weren't allowed to do that. So 2006, you may have heard of a scoring model called Vantage Score. Vantage Score is owned and operated exclusively by the three credit bureaus, TransUnion, Experian, and Equifax. Basically, they saw how much money FICO is making. They became a $1 billion corporation. And they're math people, right? They're statistics company. They came up with an algorithm and they made billions riding the coattails of the three bureaus. And so the bureau said, hey, that's kind of silly. We want that money. Let's make our own scoring model. So they created Vantage Score in 2006. And the problem is Vantage Score can't leverage their way into the lending space because all the lenders are using FICO because that was the law, and everything, it all starts at mortgages. That's the big thing. And then everything kind of filters down. So they tend to use FICO for credit cards and auto lending and everything. So Vantage Score, powered behind the three credit bureaus, has a very powerful lobbying, and they've been lobbying since 2014, the Congress, to pass a law to change it where, hey, the mortgage industry can change. They can use new scoring models. So in 2018, there was a law called the Economic Growth Regulatory Relief Consumer Protection Act. Trump signed that in 2018 and it became a law. That included a section called credit score competition. That's the section that says FHFA, which is Federal Housing Finance Authority, I believe it stands for. They run Fannie and Freddie. They're the ones that decide what scoring models are used. That law said FHFA now must consider new models. Now, move forward from 2018 to 2022, we're in the middle of that all changing. So basically, the process, what the law said was FHFA must validate any scoring model, basically test it and make sure it's working, and then adopt it. And that's for any model. Even the current model that's being used right now had to be validated. So they had to create a validation process and then approve it and then validate it. So when they did that, there's only a couple models that were submitted, because Vantage Score and FICO Score are the only really two players in the credit score space. So they submitted their models. We're going to talk more about what that actually means, where that's going. But before we get into that, we need to really talk about something that's the elephant in the room that people think they know, but they don't really understand how credit scores work. What does a score really mean? Because people tend to think that a credit score is a grade of what you've done in the past. Like it's a test score. Like you have your report, you have a score, it's a grade of what you've done in the past. And that is not how it works. Credit scores are not a grade of what you've done in the past. It's a prediction of what you're going to do in the future. Now that's really, really important to understand, because everything that you learn and understand about how credit scoring works, it starts to make sense if you understand that one concept. It's not it's not a test score. It's more of a horoscope. It's predicting what you're going to do in the future, because they were created to help lenders figure out if they want to lend you money. And the way lenders don't come out just necessarily and say this, but the way they really look at it is, if I lend you money, are you going to pay me in the future? That's what it's designed to do. Underwriters and people that look at credit reports, they know what they're looking at. They can see what happened in the past. They're more concerned with what's going to happen in the future. So there's not one scoring model out there. There
Hey,
are, and
Jim.
by the way, yeah,
Hey,
go ahead.
Jim, I'm sneaking a question in from Ilona, but I think
Yeah,
it's
please.
relative to the point you just finished. So she had asked, based on what Jim's talking about, so the credit reporting agencies are basically trying to predict your success at being a good borrower in a specific type of borrowing. So Ilona asks a question: why do car scores seem to be lower than mortgage scores? And I want you to kind of, I think that was a good place to kind of explain that.
Yeah, it absolutely is, because it's my next slide, actually.
I was waiting. I wasn't sure.
No, that's fine. So here, FICO scores are not just, it's not just a random prediction of what you're going to do in the future. The specific definition of the algorithm is predicting the likelihood that the consumer may become 90 days or more delinquent within the next 24 months. That's the specific definition of the algorithm. Now, to the question, here, by the way, this slide shows 20, I think it's 25 or 28 of the different FICO models that are commercially used. There's 40 of them in total. And conceptually, here's the reason why the scores are different when you go to a car dealership, or Rich, when you pull the mortgage scores, or when you get your statement on the credit card and it says, here's your FICO score, and they're all different. That there's a different likelihood of someone going late on a car loan versus going late on a mortgage. And there's also a different likelihood that they're going to go late on a credit card. And so this is, I know we're recording this, so this is kind of a loose statement, but your credit card company doesn't care if you pay your car loan. They care if you pay your credit card, right? I mean, it's just, these are industry specific scoring models that are dialed in to help lenders figure out, I'm lending money on an auto loan. What's the likelihood they're going to pay an auto loan back? And there's a lot. So when you see FICO scores, there's every one of these models is going to have a different number to it. It's just people get used to saying, forget Credit Karma and just look at your FICO score. Okay, when people ask me what my FICO score is, I only have one answer: which model? That's it, because every one of them is going to be a different score. And now there's also another reason why the auto loan scores are different than the mortgages. Most FICO models have a range of 300 to 850. In the auto lending scoring models and the credit card lending, they go from 250 to 900. They have a wider range. So everybody's looking at the same information. And by the way, when you go to Credit Karma, or anybody goes, and I'm not against Credit Karma, but I'm not a fan of it. People just need to not be misled about what the information really means. That's all. It's good to look at it, but people can't take it as, that's my lending score, because it's really not. So every one of these scores is going to be different. Now, people will say, okay, well, FICO score, it must be close, right? If one FICO score, they can't be that different. And here's a slide that I show to show how different these scores actually can be. Now, this is my daughter's credit report. When she was 19, she went with her to a car dealership, and they ran her credit. This is one credit report. It's only TransUnion on the same day. And they ran, a lot of car dealerships, they'll have multiple different lenders. Some lenders will use auto loan FICO 8 or auto loan FICO 4. And depending on which score is better, the car dealership says, okay, well, let's use the higher one and let's send it to that lender. So this is a really, really good example just to show the impact of the same exact credit report, how different the scores can be on two different FICO models on the same day. One of those scores is 844 and the other one is 668. It's 176 point difference. It's enormous. And by the way, I'm not going to go down this path too much, but the reason is that I have her from the day she was 15 on 4 of my authorized user credit cards. The 668 score does not acknowledge authorized user accounts in their scoring algorithm. They can see them, but they disregard them. And that just goes to show you the power of an authorized user account.
Hey, Jim, that's a great, they're always looking for good takeaways in these types of events,
Yeah.
but certainly if you have teenage children, what a great takeaway to get them added and start building their credit even before they're 18. So that's a great
They were
takeaway.
12 and 15. They were on my cards, and both, I have 2 daughters, both of them on their 18th birthday in the morning. They're like, what'd you get me? And I pull them over to the computer because that was the first time I could run their credit reports. And I run their credit, and all 3 of their scores for both of them, they were over 800. And they're like, okay, what am I going to do with that? So they just have no idea what that actually means, but I was very happy with it.
There you go.
Well,
Hey, Jim, I got to ask one quick question too, since we get a little break. So can you ask the question? This isn't necessarily credit related, but I'm going to try to tackle it real quick. And at weekend, we appreciate the questions. So she had asked, can first-time homebuyers using bank statements for funding get additional grants like first-time homebuyer grants? So ultimately, what I think there is a way to use bank statements to qualify in mortgage programs as income. However, I am not aware of any down payment assistance that would allow a bank statement type program to also consider income just off of deposits of bank statements. So I'm not aware of any at this time. So that's Jim, back to you. Oh, wait, we got one more. Okay. So Kim wanted to know, do you have to wait till your kids are 18 to pull their credit?
Yes.
Okay. Why is that, by the way?
Because you can't borrow money until you're 18, so they don't generate a report. Now, it doesn't mean they can't have a credit report, actually. You can't, you will not get a score. You could request a report from the bureaus, because as long as there's activity, then you can get a credit report. But if you go to like a credit monitoring site, they won't deliver a credit report. You can get it directly from the bureaus. But typically there's no credit report until there's some sort of activity. And there's a lot of things we can talk about how to protect your kids' identities, because the identity theft for minors is a big deal too. So, but we can talk about that at another time. So, I want you guys to, yeah, go ahead.
Judy's got a question for you. When someone has, and this kind of talks about like to your kids, but when someone has no credit, what would you recommend to get credit if they can't be on anyone else's credit card, so they don't have access to somebody that would make them an authorized user? And how long does it usually take to build some credit?
Well, the short answer is you have to have something on your credit report, of course, and usually that means you have to start out. The first place is usually a secured card. If you can get an unsecured card from your bank or something like that, that's great. A lot of times, if you have nothing on your credit, you have to start with some kind of secured card or some kind of account. Now, you will not get a FICO. There's no such thing as a 0 FICO score, by the way. There is no FICO score, though. And in order to generate a FICO score, you have to have one account be reported within the last 6 months and one account that's at least 6 months old. If you don't meet those 2 criteria, you will not get a credit score.
So repeat that again. You have to have one account that's 6 months old. And what was the other thing?
One account be 6 months old and reported within 6 months.
Got it. Okay.
Basically, I mean, think about it. Your credit is being pulled today. You have anything in the past, right? But they're predicting the future. The reason why FICO won't give a credit score is if you don't have anything that's been happening recently. Like a lot of people, they let their credit, they just stop using it, right? They went through a bad event, or they maybe just don't need credit. They're not using any credit cards. If your credit all goes stagnant and you have nothing reported within 6 months, you may have credit on your report, but FICO won't generate a score, because they're basically saying, hey, you know what? We don't know enough about what you've been up to lately to predict what you're going to do in the future. So you have to have some sort of history that's at least 6 months old and something that has been reported within 6 months.
And then to go into Judy's question, then did you want to talk about authorized user, not authorized user, I'm sorry, secured credit cards? Because that's one of the ways, right?
Yeah, that's what I was saying, is that secured credit cards is generally what you have to start with in most of those instances.
Okay. And did you tell everybody what a secured credit card was?
No, no.
Okay.
Well, only because there's a lot for us to cover with this, but a secured card is basically you have to give money to get some kind of, you have to collateralize your unsecured debt with your own money, basically. Give them $300, they give you a $300 credit card.
Yeah, and some of the banks that if somebody's in that situation and they have a checking account with their bank, they may want to start with their bank and like Jim said, they could walk into their bank, say, hey, looking to build credit. Do you have a secured credit card program? Yes, they give them $300. You get the $300 credit line. You're off to the races, and you're in the game. You're in the credit game.
Yep.
Yeah.
So let's look at this slide real quick. And anyone that has experience of kind of guess at some of these, and Rich, you can chime in here too. We have two different borrowers, right? They both have exactly the same profile. These are identical, right? They're really good credit situations. Borrower one has 4 open credit cards, an open auto loan, closed auto loan, good mortgage, good history. That person is as solid as can be on credit. What would you guess? Anybody throw out a number, Rich or whoever, what would you say a range of what that score might look like for borrower number one? Mid sevens, maybe something like that, 750, upper sevens even possibly. And there's nothing derogatory, right?
Same balances as well, limit all is perfect. Yeah, you would think.
I mean, nothing's wrong with it, right? That's a solid credit borrower. Borrower number two is the same person, except they have an unpaid judgment for $12,500. They have an IRS tax lien for $26,000. They have 4 unpaid medical collections of $400 each. They have a paid medical collection for $3,400, a collection from Verizon that's paid for $1,285, an apartment rental, which nobody likes to see that they paid, but it's a collection on their credit report for $4,350. So they have 7 collections, a judgment, and a tax lien on their mortgage report. Anybody want to guess what maybe that range of that credit profile might look like?
So we did get some guesses, first of all, Jim, for
Sure.
borrower one. Ken, you said 710, Max said 720, Tamara said 700. And now I think we're getting the other scores. So Ken, you said 485, Tamara said 350 to 400, Mariola said 520, and Mac said 530.
Okay, all good ranges and all good guesses. And here, there's not an exact answer to this, but the ranges that I would say is probably the borrower number one is probably in that mid 700s, right? Borrower number two, with all that stuff on there, that they're probably low 600s, maybe high 500s, something like that. So clearly two different borrowers, correct? Right? I mean, probably 100 plus points at least different. Okay. Now I want you to remember these two scenarios, because we're going to come back to that after we talk about some of the changes that are happening, but we can all agree these are two different people, right? So let's talk really quick. You may have seen this before. I want to talk about what goes into the FICO scores a little bit. I'm not going to cover each one of these things because this is basically the FICO pie chart, they call it. It's the components that comprise everybody's credit scores, past delinquencies, debt ratios. But again, for lack of time and more important things that we need to cover about these changes, there's only a couple of things I want to talk about these scores. First of all, debt utilization. Debt utilization is not debt to income. Your income has nothing to do with your credit reports and your scores, because they don't know that information on a credit report. Now, it's very important on the loan application. Certainly, it's going to be part of the lending decision, but your income is not known to your credit reports, and therefore it's not a calculation in the score. Debt utilization is not entirely credit card related, but the lion's share of it is the balance on your credit cards in relation to your credit limits, right? Now, the reason I have 30% with question marks there is most people hear all the time, yep, that's a really important thing. Keep your balances at 30% of your credit limits, right? It's all that information's all over Google. Bankers talk about it. Lenders will tell you it's 30% or 29%. It's even on FICO's blog to keep it at about 29%. But here's the thing. Don't tell your clients to keep it at 29 or 30%, because that is not the best answer. It's not necessarily wrong. It's not a very good answer, because the closer you get to the limit, your scores keep dropping, right? So if you're at 30%, that's better than being at 50%, right? But if you're at 100, 50 is better than 100. So here's the thing. You're not maximizing your points if you're at 30% in that category. You want to have your clients be at about 1 to 5% of the credit of the utilization. That's what we tell people, 5 to 10%. 10% is fine. But to optimize it, remember, this is an algorithm. This is a mathematical statistical formula. How do you maximize that particular component of your scores? Being in single digits of your debt utilization. And so you're not going to see 50 or 100 points if you go from 30% down to 5%. But if you want to maximize your points, you will see a point increase by dropping your utilization lower. Now, just so you know, a lot of people will say, well, I'll just pay it off to zero. I mean, if I can pay it off, it's only a $200 balance. And by the way, scoring models use the percentage, not the dollar amount. So when you have a $250 balance on a $300 limit, that is no different than owing $25,000 on a $30,000 limit. It's the same exact percentage. And people aren't told that. And so it's hard. They keep that card in their wallet and they use it. And it's so easy to charge up a couple $100 in a month, of course. But that means you're going to be at 80%. You can pay every payment on time and still be dropping your scores. Now, the reason why zero is not as good as a small percentage is because the credit scoring algorithms are trying to figure you out. They're trying to predict your activity in the future. If it's at zero, you're not using the card. They're looking for clues of you using the credit, but not abusing the credit. They never define that in the credit card agreement when they send it to you, though. And it's the scoring models have no obligation to tell you any of that, but that's really what they're looking for, is using it in a very small percentage, but not abusing it. Okay.
So Jim, real quick on that last part with the credit card utilization, when we're pulling credit here across country, one of the things we have embedded in our system is, hey, how much could this potential borrower's credit score improve? It's one of the very first thing that comes up on our credit reports. And it'll tell us, well, your borrower right now has a 620 score. We think if they do a few things, they may be able to get up to a 640 score. Well,
Sure.
That could mean the difference from having down payment assistance available to you or not having down payment assistance. And oftentimes when we pursue it, it is all about, hey, can we pay down a couple credit cards, get the percentages a little bit lower? Again, Jim gave you the ideal percentage, but the algorithms it can be a little odd as far as where we need to pay them down. So we're always looking at that to try to get our borrowers better interest rates and better benefits. Now, I want to remind everybody, I know we had a couple people come in late. We are incenting you to give us questions. And so if you have questions, fire them away in the chat. We have gifts for you. All right, Jim, what happens if we close credit cards?
There shouldn't be anything because you should never close a credit card. That's the answer. So you don't ever want to close credit cards. That's the rule of thumb. There's actually one exception to that. If you have a secured card, at some point, you're going to want that $300 back. And so at some point you will want to close that card and that card only. But you don't want to do that until you've used it as a stepping stone to get the cards that you really need. So for closing credit cards, there's a lot of rumors that you lose all the history. Don't close your card because you lose all that good. You don't lose any of that. All of your good history stays on your credit report. There's other reasons why you don't close credit cards, but we're not going to have time. That could be another little chat that we do about that, because there's a lot of things we can dive into. But as a rule of thumb, never close credit cards and stay away from store cards. You don't need 20% off at Target. So just stay away from store cards, stick with Visas and MasterCards. It's just healthier. Your mix of credit, if somebody doesn't have credit, ideally you want to have one auto loan or installment loan, 3 to 5 credit cards, and a mortgage. That's kind of like your ideal mix. You can have really good credit, having a little less than that or more than that. It's how you manage it the right way. But you must have credit cards to have good credit. It's just, there's too many clues that they give you. So if somebody doesn't have anything, that's the first place to start. And by the way, like Rich was saying, there's a lot of different, there's a lot of ways to look at these things. And we're trying to give you the bigger picture, but mostly this is about giving you some education and knowledge about these things, but also developing that relationship so you know that we are here to help you and your clients understand how this all works so we can help you close more sales. So authorized users, we talked a little bit about this. What I wanted to bring up about this, there's a lot of credit companies out there that rent and sell trade lines. Stay away from that. It's fraud. They just haven't been in trouble with the government yet, but I've heard it directly from enforcement attorney at the Federal Trade Commission that it's deceptive, it's fraud. And here's the reason why is that, yes, technically you're an authorized user because they added you to the card. But here's the thing, are you really an authorized user? Because you will never know if you rent a trade line online, you never know the name of the person whose card it is. You'll never ever have access to that card. And all you're doing is you're basically buying that person's good credit line. That's it. So that's deceptive because you're telling the credit bureaus you're an authorized user when in reality, as a function, you're not an authorized user. So it's just not on their radar yet, but you know, there's other better ways to build credit. So just as a rule of thumb, people that look to that as an avenue to build credit, stay away from the renting and buying of trade lines. On inquiries, I just want to bring this up a little bit. There's a lot of people freak out about inquiries, like multiple inquiries on mortgages or auto loans are actually the big one, because car dealerships tend to push one button and it shotguns it to 5 to 7 places. Then you go to another place and all of a sudden you got 20, 30 inquiries on your credit report. FICO scores and Vantage scores for that matter, they have technology built into the scoring models that allow people to shop for interest rates when you're going to buy a car. And so there's a window of time that they will compress all of those inquiries if they're all for the same purchase. Like if you have 30 auto loan inquiries, if they are dated within 30 days of each other, they all compress to only count as one on your scores. Now, different scoring models have different windows. Vantage score uses 14 days. FICO models range anywhere from 30 to 45 days. I just tell people, hey, just kind of go with because it's a little bit of information overload. Just kind of treat it as 30 days. That's the window. If they're all for the same purchase, then it's not going to impact their scores. Okay. So,
hey, Jim, on that, I want to cover one quick thing. So a lot of our agents that, you know, are advocates for us and our team, you know, they typically want to make sure they're working with a lender that they know and trust. And sometimes a buyer will come in with a pre-approval from, we'll say, Dewey, Cheatham and Howe Mortgage Company. And the realtor goes, oh, you know, this is going to be a nightmare. I got to make sure I've got a good, reputable company to work with. And they'll ask their clients, hey, you know what, I know you have that approval. However, my guy is somebody I trust. I know he's going to close you on time. I know there's not going to be surprises. He's available, great communication. And the clients will say, yeah, but you know what, Mr. and Mrs. Realtor, I don't want my credit pulled again. So this is good information to explain that it's okay if another mortgage company pulls your credit within that time frame, because it's not going to have a negative impact on your score. So that's good information.
Yeah, and I mean, all the lenders use the same models too. So there's the reasons why Rich will need to pull the credit report if somebody else did. First of all, if it's in the window when Rich pulls it, if somebody else did, it's not going to impact the scores. And then he needs that credit report to get a fast track approval or whatever it may be, so that he can move forward for a pre-approval. But people, you know, consumers will keep shopping thinking that they're going to get a better score at another lender, and that just isn't the case. It's all the same model. So anyway, let's get into the changes to reporting that have been happening. These two are really, really big. All tax liens and judgments have been removed from credit reports. Now that happened about 2.5 to 3 years ago. It was announced by there's kind of a big backstory to it, but basically the credit bureaus were told that Hey, there's a lot of complaints about people saying that the wrong judgments and tax liens are on their credit reports. So, or they're on the wrong people's credit reports. So you have to get it right, figure it out. And so the Bureau said, okay, what do you want us to do? They said, match up the consumer report file with the date and birth, date of birth and the social security number that matches the tax liens and judgments. And the answer is, well, that all that information isn't on those documents. So how do you want us to do it? And the government basically said, we don't care, figure it out. So they had to do that. So basically, if you read between the lines, they basically said, okay, we are going to report tax liens and judgments only when we can meet the criteria that we're being required to follow, which basically means they had to remove them all from the credit reports. So here's the thing, when tax liens exist and judgments exist, it is not a get out of jail free card to do a mortgage, because they will appear on a mortgage report. And there's a reason for that. Your clients will not see these items on Credit Karma or Experian.com or any place they look, because they're not on TransUnion, Experian, and Equifax. They will show up on a mortgage report, because a mortgage report is not just a credit report. It's called a tri-merge. It's a residential mortgage credit report. But they compile the data from TransUnion, Experian, and Equifax, the tri-merge. But there's also a fourth place that they get their data from called LexisNexis. That is the reporting system for court records. I saw that coming as soon as they said they were going to delete these, because mortgage lenders can't ignore judgments and tax liens. So now they really should be called a quad merge, not a tri-merge, because they're getting their information from 4 places. So from a good perspective for the consumer, if it does show up on a mortgage credit report, it is not impacting the scores at all, because it's not on the 3 credit reports, but it is on LexisNexis. It'll have to be addressed. Rich can help you with that, figure out the game plan of that, of course. But from a credit reporting and credit scoring standpoint, those don't matter anymore, okay? Medical debts, this is another big one. You probably have heard this recently. That and medical debts are different, right? Medical collections are, it's not like somebody goes out and buys a big screen TV and doesn't pay for it. I mean, it's medical, right? They have a procedure or something. And so it should really be classified different, but it can't necessarily be completely ignored, but they've changed how they're going to report them. So no medical debt can be reported for 365 days from the date of service. Basically, they want some time to have it be worked out with the insurance. But not only that, give the consumer time to make the payment if they're on the hook for it, right? So they can get it paid before 365 days. So that's when it can report to the credit bureaus. All paid medical collections are deleted now from credit reports. I shouldn't say paid, zero balance collections. So if they settle it, if there's an agreement to make that balance zero, if the debt collector makes it zero out of the goodness of their hearts, that's fine. If it's a zero balance, it's deleted off of the credit reports. That's a big deal. That's a win for everybody. All medical collections under $500 will not be reported. Now that's not happening yet. By the way, the deleted medical collections that are zero, that's going on right now. That started in July. Medical collections under $500, that's going to start happening where they're not going to report those until 2023. I'm not sure how debt collectors are going to respond to that, because they're pretty clever too. I don't know if they may take a lot of smaller ones, 200 here, 100 here, and kind of lump them together into one, so it's over $500 and it can report. Who knows? That's all you have to be seen. There's always a action and reaction when it comes to credit reporting, but these are the rules how medical collections are being handled. Now, all that being said, let's get back to that credit score competition section of the Economic Growth and Regulatory Relief Act. Remember, that instructs FHFA to validate and approve a new mortgage scoring model. And they had to validate one model by November of 2020. And this wasn't really talked about, but they did not validate the current models from 1999. FHFA had to rush that because the mortgage industry was very close to getting shut down without ever saying it to anybody. They probably would have gotten an extension on it, but one of them had to be validated. They did validate the models currently used. That's why there was, it's business as usual. There was only 2 models submitted for validation. That means there's only 2 models that can be considered to be used in mortgage lending. It was FICO 9 and Vantage Score. And I believe it's Vantage Score 3.0. Now, the information I'm talking to you about, I have heard and seen from Mark Calabria, was the former director of the FHFA. He was the director when this Credit Score Competition Act started, and he was the one working through this process. He got asked to leave when Biden became president, but so this information came from him. I heard it from him, but FHFA has not announced what they're doing yet. It was supposed to be announced about a month ago. So all this information that we're talking about, the disclosure is, it's not officially announced by FHFA, but this information is coming from Mark Calabria, the former director. So there's only 2 models that could be considered for mortgage lending: FICO 9 and Vantage Score. Now, FICO 9 is a newer model. Right now, they're using FICO 2, 4, and 5 from 1999. So in general, nobody wants Vantage Score to have, because that's owned and operated by the credit bureaus. They don't want the credit bureaus to own the bureaus and own the scoring model. So what everyone believes is happening is that FICO 9 is going to be the mortgage scoring model that's going to be implemented for mortgage lending. Now, so now we have to look at, what is FICO 9? What changes with that, right? So there's a couple key things. And one of them is, when rent is reported, it will calculate into the scores. Now, right now, rent reported to a credit bureau is not calculated into mortgage scores. Right? Just like Experian Boost. Let me touch on that really quick. You probably have heard of Experian Boost. It's very heavily advertised. It basically is where Experian will, for an exchange of access to your checking account information, they'll put your utility data on your credit report. And there's a lot of consumers that think, okay, well, hey, if I want to boost my mortgage scores before I get a loan, let me do Experian Boost. That is not, none of the utility data is recognized under those old models. It'll show up on the Experian report, but it does nothing to the credit scores whatsoever. Now, they're going to see a FICO, remember all those different FICO models, they're going to see a model that's going to say, yeah, your score increased 8 points, 12 points, 18 points, whatever it is. But the mortgage scores or the auto loan scores are not impacted at all because they bypass that information. Same thing with rent. Those older models don't calculate rent history. However, FICO 9 will. Now, that could be a win. It might not be, if depending on if somebody pays their rent on time, of course. And that's why you're seeing a big push for a lot of companies to charge consumers to pay for rent to be added. The problem with adding rent is there's so many landlords. It's not like they're going to Bank of America and buying all their database. I mean, there's thousands. I mean, I couldn't even tell you how many landlords there are, but they have to get that data from each one to be able to put it on a credit report. But if that gets worked out and it's on a report, it's going to calculate into the scores, which could be a good thing for people. And again, if they don't pay on time on their rent, that it may not be.
You're right.
Medical collections over $500. Remember, we said that medical collections under $500 just aren't going to be there, and zero balance ones aren't going to be there. Medical collections over $500 will be devalued. Right now, the way the scoring models view a medical collection is the same as a big screen TV, right? A collection's a collection. You got a medical bill or any other collection, it impacts your credit with the same level of severity. Medical collections in FICO 9 are recognized as a medical collection, and they will devalue them. Now, devalued does not mean disregarded and not counted. It just means it holds less weight.
Hey, Jim, I got a question that came in from Tamara. We've got FICO 9 will include rent only and all of the added from Boost? Or I think the answer is rent and none of the other utilities.
Well,
right?
That's a good question. It's one of those yet to be seen things. FICO 9 will calculate Boost. if it's there. However, in a lot of lending environments, and we don't know if this is going to happen with the mortgage industry, but a lot of lenders, when Boost is on a credit report and the scoring model they're using will acknowledge Boost, they're requiring that the Boost be removed because they're adding stuff like your Netflix bill. So, you know, and so, or things like that, you know, so lenders, when they're making a decision to lend on a mortgage, don't want a superficial raise in the credit scores by something that may not be an attribute that's really indicative of their risk assessment. So they might, you know, no one knows what's going to happen with that yet. And by the way, it only impacts experience scores only. It does not impact the other 2 scores.
Mac, by the way, Jim, Mac's got a question. How much does credit repair service cost a potential buyer? And how long does it take to repair credit on average? So it's the second part's a little bit of a loaded question, but I'll let you tackle that.
Well, yeah, it depends. I mean, the job is for us to get them back to you as quickly as possible, but everyone has different scenarios, different situations. Some people are trying to get to a 580. Some people are trying to get to 740. So, I mean, you know, the situations are different. And just really quickly, I'll just tell you what our costs are. We don't charge upfront fees. Flat fees and upfront fees are completely illegal in credit repair, even though there's a lot of companies will say, hey, for $500, I'll work on your credit for 5 months. That's totally illegal because that's an advance fee. We charge after 14 days, $139 and then $99 month to month, because that's the only legal way that you can charge for credit repair. After you do services, you bill for those services. So it's month to month and they cancel whenever they want. So let me show you this last bullet point, because this is the game changer of this whole thing, I think. All collections, every collection that has a 0 balance will not be counted in the scores on a FICO 9 model. So think about that. Now, again, this is if FHFA adopts FICO 9, but FICO 9 disregards 0 balance collections completely. So if somebody has 5 collections on their credit report and they say, hey, you know what, I know I haven't paid these and they're all unpaid, but you know what, I want to get a mortgage, and they pay them to 0. Right now, a collection still is a collection. 0 balance is still bad. If they pay them, they're going to be completely disregarded as if they don't exist. They'll still be on the credit report, but they will not be counted at all. I mean, I didn't write the algorithm, right? I'm not FICO, I'm not any, but in my opinion, the presence of a collection is still an indication of risk. In my opinion, paying it to 0 is not necessarily an indicator of no risk at all. But this is also a very big win for the real estate industry, because this gives people an opportunity to pay a collection to 0 and have their scores not be impacted at all. So let's summarize this really quick, because we're running a little low on time and I want to get back to that one graphic. If FICO 9 is adopted, all tax liens have been removed. That's happening right now from credit reports, right? All judgments removed. That's happening now. No medical debt will report for 365 days. That's going on. 0 balance collections deleted as of July 1st, right? All medical collections under $500 will not report. That's happening next year. Rent's going to count in the scores if it's a FICO 9, and the medical collections of $500 or more will be devalued if it's FICO 9. And again, the big one, all the collections with a 0 balance will not be counted in the scores. So that's the wrap on that. Now let's go back to this. Remember our 750-ish borrower and our other person that's high 5s, maybe low 6s. So based on everything that I just explained to you about if FICO 9 becomes the mortgage scoring model, now, what are the difference in the scores?
It's pretty dramatic. Yeah, there is no difference.
0. Borrower 2 and borrower 1 have exactly the same mortgage scores if FICO 9's adopted. So think about that. I mean, we all agreed that these are 2 different risk borrowers, right? This is, 100, 150 points difference. if they adopt this new model, which again, I keep saying if because it's not announced yet, but when FICO 9 becomes the mortgage model, borrower 2 and borrower 1 are both mid 700s. So
Yeah, that's crazy. I mean,
it's a little
that's
shocking, isn't it?
yeah, it's a little shocking, but it's, I mean, certainly I think obviously the real estate community is going to love it because
Oh yeah, no
you got a lot
doubt.
of buyers that, go from 590 to 605, whatever. This thing comes into pass, and those borrowers are now potentially, not only do they qualify for most DPAs or down payment assistance, but they're also maybe going to get into some conventional approvals and things like that. So,
I mean, don't get me wrong. This is all a win for real estate, all completely, because it's
huge.
going to open up a whole new spectrum of borrowers or people that couldn't qualify, will qualify. The lending programs would be better. Interest rate, it's just a win-win all the way around. And now it takes a little time for transition, right? They're going to announce the adoption. I mean, everything you're hearing right now, you're ahead of the curve from anything you're going to see on Wall Street or any of the news, because they were supposed to announce it about a month ago. They're probably going to, sometime next month, maybe announce it. But when they do, then there's a transition to actually starting to use it, because they have to adopt all the mortgage-backed security markets and all these different things. And every mortgage lender has to adopt to a new lending program. So they say it could be 12 to 18 months or so to adopt into that. So we're ahead of this for sure. But I think that, as an industry in our careers, it's something that we need to know what's on the horizon, because this is a big, big deal, in my opinion.
Yeah. Yeah, it's a huge deal. So huge deal. So Ilona asked about getting copies of the slides. Actually, I think Tony sends everybody that it was in attendance a copy of the recorded. Tony can confirm that for me. Copy of the recorded. Yep, she just did in the chat. So that's good. So that's awesome. And then let's see here. Do we have any other questions? Ken, you said it was great information. We got a lot of wows on borrower number 2 having the credit score be as high as borrower number 1. So that was good feedback. So Tamara said thanks to everybody here. Jim, closing comments?
No, I think that's all. I mean, that's all. Here, there's so many different things that we can talk about in the world of credit, not just this. And I know that credit gets confusing and it gets hard to follow, but there's so much different kinds of information. And if we wanted to do another one of these and kind of tackle some different areas and more Q&A and talk about how to work towards improving credit, and particularly what we do as a credit repair company to work with people, we can dive into all different kinds of things, but I think that this was pretty a big thing to cover for today. So
yeah, and Jim's very, very affordable. You guys want to reach out to him and talk about that stuff. His contact information is in the chat. I think Tony will end up posting it again. There it is. So yeah, I mean, just a great source of information. If you guys are meeting with buyers and they say, hey, I can't buy right now because my credit's bruised. Hey, I got a guy, and Jim's been I got a guy for literally a dozen years plus. And we've been very, very happy with the services. And, to that end, he can turn them back around to you sometimes very quickly, which is great. So we've got that in there, and perfect. And then Tony said she will also send Jim's information in there. A couple things that we've got coming up tonight. We are doing a home buyers class. It's going to be from 5:30 to 6:30 via Zoom. It's for anybody thinking about buying a home. I literally rewrote the class before this. So if you guys need information on that, there is a link in the chat. And then I want to look down the road. What do we got, Tony? I got to walk away and look at the calendar.
Meet the appraiser webinar.
Yep, that's going to be September 14th. We are going to have an appraiser. That's with Jessica, correct?
Yes, it is.
Perfect. So Jessica Masad owns a company that they're actually changing their name, but they've been collateral management for a very long time. Were they Bluebird, I think is what they are by then. So ultimately, She owns a national mortgage appraisal company that handles our company. They actually get the lion's share or the majority of our work, even though we have 17 different appraisal management companies. She's one of the #1 resources. She's a phenomenal resource. If you guys got questions about appraisers, appraisals, what to do, how to help an appraiser when they come out, you're going to want to check out that lunch and learn. That's going to be September 14th from, again, 12 to 1. We'll have a sponsor on here, not as great as Lisa, because Lisa's awesome, but we will have a sponsor on there as well. The appraiser lunch and learn is in there. Jim's information you guys will all have, and I always kind of close with this. None of this stuff happens on my end without Tony and her great help in coordinating all of this. So Tony, appreciate you tremendously. Jim, appreciate our partnership. Lisa, our partnership with Enact is amazing. And we really appreciate you and your company and the things that you guys do here. For our agents that are here, we definitely love and appreciate you. If you want more information on different products we have coming up, we also have, we're probably going to do a little surprise presentation in the next 30 days on a program we just started August 11th. So with that, I'm going to let everybody go. I don't see any other questions. You guys have a great one. Thanks for joining us. Thank you, my sponsors. And Tony, take care, guys.
Thank you.
Bye, Jim.
Have a good one.